After tapping into my final key area of support, 190 to 178, the 200 EMA lying above 178 and slightly under 190 means that this area here is the final level of support before a macro trend break. This would then signal that the head and shoulders pattern should play out in a mid to long term scenario where many months pass and you see further to continuation lower. But if you've been keeping up with the updates, I've mentioned that in order to flip XRP bullish again, $3.15 must be reclaimed. So there's a lot of work to do. In the meantime, it can't lose this level. It must hold above the 200 EMA and start working up from here to reclaim the head and shoulders neckline. Everything started to go wrong on this first initial move down, especially with such a massive wick. They usually tend to get filled. Although some weeks were spent forming a bullish pattern we were seeing across the board, XRP was actually one of the best to get out of this pattern, to break out, because many didn't even manage to get the breakout. This, of course, didn't manage to meet the target, but comparing to the rest of the large caps, Bitcoin also printed this, and XRP broke out of it slightly better. However, in the end, even had it met the target, it would still just be coming into the 886 fib and then rejecting. This is the final level of resistance. Once this golden ratio is broken, then the reversal wave is created and we can start talking about these higher up targets up to $6.50. But until $3.15 is broken, those up higher targets are not a reality. So they only become a reality on the break of 315. So let's now try and discuss what sort of path XRP must take from here before it loses the macro neckline of the head and shoulders pattern. We've got two, right? We've got this diagonal one we can see was lost many weeks ago. We've also got the horizontal support of this current range. We've also got the 200 EMA in line with all of that, suggesting this has to be the bottom, or it can, of course, start a multi-month downtrend from here. It's got the pattern set up already. Even though it was bullish at some point, I was, of course, arguing that it could form a lower high under 315. In the end, it had done so and lost the neckline of the pattern. It spent a few days or weeks playing around with this 100 EMA at $2.28. Remember, in my videos the past couple of weeks, we're saying that $2.28 must hold in order to fully confirm the reclaim of this level. We can see that on the reclaim of the 100 EMA here, had a movement to attempt and confirm the head and shoulders as support once again. It failed to do so. Another attempt where it failed to do so. So these are just fake outs, actually confirming them as resistance. I'd like to see and check on the 2-day time frame if these turn out as wicks, and you can see it a lot clearer now that realistically we have actually back tested this and confirmed it as resistance. So it's actually quite a lot clearer to see on the 2-day. So what's going on down over here at this key level of support? If you've been following the updates, I've been saying 206 must hold. This is where it must bounce from and recover a minimal the $2.65, $2.71 area, because that's the neckline of this head and shoulders pattern. If you do not want to see that multi-month further correction from here on out, it's already been some months, but if you want to see further downside, then this must maintain as resistance. So of course, at all costs, to avoid that, you need to see this double bottom playing out, breaking the neckline of the double bottom itself around $2.50, but recovering the head and shoulders neckline at this moment. That's around the 618 and 65 golden ratio level, but need to break that final level of the golden ratio, 886, and then on that break, I have full confidence I'll be the most bullish out of all of you, because I know the consequences of this signal. While under, no chances of going up. Even if we're looking like we're traveling up there, could get knocked back down into new lows and still go into a deep correction. Look, it's kind of happened from here already. It's attempted to come and climb all the way back up. In fact, look at the same candle. It started up there, so it was at the 786 and it was down at the 0 fib and as high as the 786, all within that one candle. So even from here, we can draw across like that. We can see move down, move back up, move all the way back down to here. So it's not yet losing the low. That is still being protected. We have those moving averages on the daily, the 200s down here. On the 2 dailies, the 100, of course. And still got these resistance ones, but while the lower end support, more macro, taking in a larger amount of time to create that average 100 2-day candles. Also, of course, 200 daily candles. And then, of course, being a macro support, maintaining the uptrend, we need to see the consequences from that by breaking all three red boxes from here: 246, 265 to 270, and then ultimately 315. On that recovery, we can then talk about those higher up targets. Until then, I'm going to keep warning of this downside potential, because that is actually the natural path that we're on. My bias is that we are bearish. In fact, I've been bearish ever since up over here, especially at these two high points. I kept on winning. It looks amazing right now. Money is being made from an account balance down at 194 to an account balance at 299. Don't get me wrong, but we can see it did not sustain in the end, and it's only going to actually sustain if we see Bitcoin really showing who's boss. So check out my Bitcoin update if you do have some further time coming out of this video. Remember that we need to see all three of these levels recovered, and then we can start being bullish again. That is it from me today. Be cautious out there. I'll catch you in the next one. Like, subscribe, comment, and share if you want to get educated or want further content. I actually host group live workshops to mentor you guys, and I have one tonight hosted in the Discord community. Check out the membership levels, link in the description.